Good morning, everybody, and welcome to session 2 of our Disciple Bootcamp, a series of webinars we're doing to commemorate the release of our newest book, In the Trading Cockpit with the O'Neill Disciples. And in this session, what we're going to be covering are Buyable Gapups, one of my favorite topics. And I've got Dr. K, Chris Ketcher, with us here as well. So I just want to make sure that you all understand that any stocks we're discussing here do not constitute an offer to buy. It's not a recommendation, and all the information we're using we think is accurate, and we assume so unless we know otherwise, but it's possible that some of it may not be accurate, so we just want to warn you against that. And also that some of the stocks we talk about we may currently own, or we may currently not own, or we may be long, or we may be short, but we may have an interest in them, so just a fair disclosure there. But the basic idea here is that whatever we're talking about, you understand that there is risk in investing in stocks, and that by using the information in this Buyable Gapup presentation, you take responsibility for your own investment decisions. In other words, use the material in this presentation at your own discretion and at your own risk. So just want to let you know the moving averages that you see on the charts. There will be a magenta line, which is a 10-day simple moving average. On some of the charts, a green 20-day simple moving average. On all of the charts, you'll see a blue 50-day moving average. On some of them, you'll see a black 65-day exponential moving average and a red 200-day simple moving average. We generally just use the 10-day, the 50-day, and the 200-day. But on some of these charts, because we use them for all kinds of presentations, we do show a 20 and a 65-day, which are moving averages that I use on the short side primarily, and occasionally on the long side, particularly when we've dealt with the iShares Silver ETF, which is the SLV. Oh, and I should mention we'd like to thank our chart providers, High Growth Stock Investor and eSignal, who are very generous in letting us use their charts. So let's get started. Gap up moves usually look way too crazy to buy, and I think what drives most people away from this is the fact that you see this big move, and for the most part it looks like you've missed it. You know, you should have been in the stock earlier, now it's had its move, and you've missed it. So most people, when you show them this chart, will look at it and go, that's just too crazy to buy, I'm not going to buy that. But what we find is this one actually occurred in Crocs in May of 2007, and it's the same chart. All we're doing is showing the ensuing roughly month and a half to 2 month move in the stock following this gap up move, and you can see that the stock started a very nice upside trend, and from there had a huge move to the upside as the year progressed, finally topping in October 2007. But you can see that the Buyable Gap Up, the huge thrust of this sort of rocket launching off of the launch pad here on this massive volume, created a very viable situation, and actually a very low risk or manageable risk situation that launched a huge move in the stock. So what we find is when these work, oftentimes they do presage or launch a major move in the stock. So why do they tend to work? Well, first of all, if you think of a Buyable Gap Up as really a sort of a conclusion to an argument between buyers and sellers, when you see a stock gapping up on tremendous volume, then the argument has basically been won decisively by the buyers. So the power or the decisiveness, you might say, with which this argument is won is characterized by sharp upside price movement accompanied by a significant increase in trading volume. So this is basically what you might call a signature, the signature of a Buyable Gap Up. Huge volume on a huge gap up tells you that the buyers are winning the argument and institutions are in there buying the stock with conviction. That massive volume is not a consortium of grandmothers buying 50 shares each. That's big institutions coming in there and piling into the stock with a great deal of conviction, and it's really what drives the ensuing price move. Now, I think the fourth reason why Buyable Gap Ups work, and probably the most interesting, and I think it's valid, is that Buyable Gap Ups are aided by what you might consider a unique contrarian aspect, in that most investors don't believe the gap and are afraid to buy it because they think it is too high. So the crowd doesn't want to buy this, and that's why it works, because the market tends to fool the crowd most of the time. So here you can see an example of Biogen back in April of 2011. You had a gap up coming out of the shallow uptrend, and you see the massive volume. So you can pretty much eyeball these when you see them. And it's really not hard to identify, not much more than, say, the footprint of a giant institutional investor. This is what institutional investor footprints look like, as you may know from our previous Pocket Pivot presentation last week. So basically, the characteristics of a Buyable gap up. What is a Buyable gap up? Well, they should occur in fundamentally strong and sound leading stocks, or there should be a compelling thematic basis for consideration. Sometimes this can vary a little bit. So, for example, you could have a turnaround situation that's a Buyable gap up. We saw this recently with Krispy Kreme donuts, for those of you who follow us on our website, selfishinvesting.com. There could be also some sort of fundamental thematic basis, such as, for example, the solar move back in 2007, or more recently the rare earth metals move in some stocks, where the fundamentals weren't exactly what we would consider perfect for our style of investing, but there was an overwhelming or compelling thematic basis for their price moves. Now, for those of you who are quants and you need a precise definition of what range of a gap up you must have for a Buyable gap up, then what we look at statistically is that it should be at least 0.7 times or 3/4 the stock's 40-day average true range. And you can find 40-day average true range on a number of charting systems as well as quote systems. I know eSignal has it, and I'm sure there are several others. And most of all, and of course this is the volume signature, a Buyable gap up move must occur on volume that is at least 1.5 times or 150% above the 50-day moving average of daily trading volume. So in other words, if it's trading 1 million shares on average per day, you want to see it trading 1.5 times that, or, Dr. K, what would that be?
1.5 times or 150% above the 50-day.
Right. So that would be what, 1.5 million or 2.5 million?
Well, if the average, whatever the average is, you want to have 1.5 times that amount.
So if it was a million shares, then it would be 1.5 million shares. Am I correct?
Yeah.
Okay. Just in case anybody wants a specific answer there. Buyable gap ups for.
If anyone has any questions about this presentation, feel free to chime in, type in, and Gil will hand it off to me. And if you have questions after the presentation, go ahead and email us at selfishinvesting.com.
Okay, number 4, Buyable gap ups should occur within an uptrend or a constructive consolidation. So when you see them coming out of a base, a proper base, that's usually the most optimal sort of setup. You can also see them occurring out of, say, shallow uptrends, but you never want to be buying Buyable gap ups while stock is in a discernible downtrend. Now, the key feature that makes a Buyable gap up probably the least risky buy point, or one of the risky buy points, depending on where the intraday low of the gap up day occurs versus where it closes, the Buyable gap up should hold above the intraday low of the gap up day. So let's say a stock is trading at $40 one day, and the next day gaps up to 45, pulls back to 44.50 during the day, and closes at 46. In that case, the 44.50 intraday low would be your downside stop, which is generally a lot closer than, say, 7 or 8%. So the reality with the Buyable gap up is that you can control the risk reasonably well, and certainly just as well as any other sort of buy point, including a standard base breakout or even a pocket pivot. So, that's I think what makes these most attractive, and the fact that when they do work, you see some pretty amazing upside price moves. They're actually my favorite buy point when I see them, but it doesn't mean they all work. But when they do, you put yourself in position to make some pretty decent money.
Yeah, you might not want to go in whole hog at the open on the gap up, simply because sometimes the stock will retrace and you don't know how far that stock's going to retrace. So in other words, even if it gaps up to 45, it might retrace back to, say, 41 or 42, especially if it's a volatile name. In general, if you have a good market environment and you have a legitimate Buyable gap up, it generally doesn't retrace a whole lot. So generally you're going to probably be risking 5% at most if you're buying it at the open. But we tell more conservative investors, buy half at the open and then look how the stock trades the rest of the day and then round out your position later on that day.
Now here we can see the quantified aspect of a Buyable gap up, the fact that it has to move up 0.75 times the 40-day average true range. So we generated this chart on eSignal. You can see the day before the gap up, the average true range was 6.26 points, and the gap up move the next day was 24.12 points. So that's pretty easy to see that that's well above the required point move that you're looking to see in the stock. And the bottom line is that even if you want to use this precise calculation, and some people do prefer that, just their nature, it's not really that necessary. When you have a real decent Buyable gap up, you can pretty much eyeball it. You can get a sense that that's what you're looking for, and not necessarily that you have to calculate it precisely out. But for those of you who like the precision, and as Dr. K has statistically analyzed these, this is how it works out. Here's an example of Baidu. Now you can see here's the stock that moves up and then it pulls back, but it doesn't close below the intraday low of the Buyable gap up day. Now in some cases with a more volatile stock, and back at the time Baidu was a more volatile stock, you could allow for 2 to 3% additional downside porosity if, say, your entry point on the Buyable gap up was pretty close to the intraday low. The closer you can buy to that intraday low during the day, assuming you can figure out where it is during the day, the lower your risk is in terms of it stopping you out. And so you could allow 2 to 3%, because with more volatile stocks, you will see some of that occur, where it'll shake beneath there and then turn around and go back up. So you could wait until the end of the day to see if it closes below, or you could just use it as a very hard stop if you wanted to. Now here's one occurring in Priceline, and you can see when this occurs, huge volume, and the stock's off to the races after that. Being a big cap stock, Priceline didn't charge higher the way, say, Crocs did, but you can see that once the Buyable gap up occurs, it's a very nice buy point. Actually never looks back and tests that intraday low. Here's Roby Corporation. Now here's a stock where it started to break out but then failed, and you can see it dropping below the blue 50-day moving average, and actually even the 65-day exponential, although that's not really relevant to how we would operate with these. But you can see the very next day, let's say if you were shaken out of the position here, you get a Buyable gap up the next day, and once it establishes that low, so you have your stop out reference point, then what you're looking at is a Buyable gap up, and if you did get shaken out, you would want to be buying back into that stock. And it never looked back and tested that low really at all. This pullback was pretty shallow, and the stock continued higher after that. Here's Netflix, and here's an example of, if any of you attended last week's workshop or webinar, this is how we use pocket pivots and Buyable gap ups together, and this is a good example because you see the Buyable gap up, the stock runs up very nicely, and then it just fails, and I'm guessing that's probably because the market was failing. I think was this around the flash crash? No, that was in 2010. But in any case, probably the market was getting into a little bit of trouble here, but this comes all the way in and fills the gap completely, so you would have been stopped out probably right in here. And what happens is it turns around and then you actually get a pocket pivot buy point. So once you do get stopped out, if a stock turns around, a lot of times you will see a new buy point emerge, and that would be where you can come back in. And this is usually going to be a pocket pivot. And so when you get blown out of a Buyable gap up and a stock turns out to be strong, a lot of times the re-entry point will show up maybe a little bit higher, but a lot of times in a pocket pivot form, rather. And to me, I don't care where I buy stock. I care about where it goes after I buy it. So if I got stopped out of this and the potential was for it to go lower, I'm happy to be stopped out, but I'm also happy to buy back in even higher than where I got stopped out if it's going to continue moving higher like that. But I think a good example there, Riverbed Technology in 2010 again. And if you look at a lot of these, and even in our new book we show a lot of these examples because we find that training people's eyes to pick these things off real quickly is really the key point of getting it across to this method across to people. And as you're looking at charts, you can immediately just eyeball it and see that this is a Buyable gap up. And so here's one in Riverbed that got its move going back in 2010, late 2010. Acme Packet pulls in. You notice here it has a little bit of a 50-day moving average violation intraday, but then it turns back around. but it never undercuts this low. So if you had bought it, you could have used the 50-day moving average as your stop, or you could have used the low. This gives you a little more room, especially if you're in pretty close to the low of the day here, so it would help to keep you in the position. Here's Acme Packet's move back when it started as a teenager, around 11, 12 bucks when it got going, and big move straight up from there. Here's Jazz Pharmaceuticals back in late 2010, started at around 15, and the stock launched a lot higher from there, never looked back. Google in 2005. This was the second leg of its big move, which it actually started after coming public in, I believe, August of 2004. It had one big move going into the end of August, I think into early 2005, and then it based for a period of time, and it broke out again with a viable gap-up move that continued to take the stock higher. Baidu, again, this is actually when it started its big move back in 2007. Remember, Baidu came public in 2005, went sideways for not quite 2 years, and then finally broke out, and when it did break out, it did so initially on a viable gap-up. But being a volatile stock, you see that you get a little bit of porosity, as Dr. K calls it, through the intraday low. But if you're allowing for some of that with a volatile stock, especially if you consider that from the left side, there is some overhead resistance in the pattern as it comes up here. So for it to pull back slightly with the volume drying up, that's probably okay. And you have to take this into account given the context of the overall chart pattern. So, you know, if something's free and clear of any overhead resistance, it will obviously not have a tendency to run into some get even type of sellers. But in this case, that was a factor. So you always have to be judging these within the context of the overall chart pattern. Now here's Apple breaking into the clear in 2004. This is a viable gap-up that I participated in very nicely, and I'm guessing Dr. K did as well. And the stock, you know, was in a shallow uptrend at the time, and we talk about this in the new book, actually, and how I was messing around with the position all in through here is either exciting me and boring me on any given day, and just shallow uptrend, not really that exciting, but steady upside progress, very, very slow. And then boom, and where does the real move start? It starts with that viable gap up, and most people would not want to buy this, but I bought this thing hand over fist, and it continued much higher by the end of the year. Now here's a case where you have Apple breaking out of the lower part of the space on what is a viable gap up, but again, remember, context is everything, and what we notice here is that you are running into a little bit of overhead on the left side, so it does stall out a little bit, so that's not really a big problem, but it holds the intraday low of that viable gap up date, nevertheless, moves up a little bit slower because it's got to work through the overhead, and then here you have a breakout coming out of the top here. Here's a big move in Biogen. I think we showed this one before, but there's another gap up in here, and this illustrates when you probably want to consider a viable gap up to be too risky, and that is when it's probably the second or third or fourth one in a pattern, and also the magnitude and the position of the viable gap up. So the magnitude of the move as well as the position from which it occurs. And what you see here is when this one occurs, you're coming out, this first viable gap up, you're coming out of this shallow uptrend. That's the constructive pattern you want to see. Once you start running straight up, this becomes more of an exhaustion gap because you're not coming out of any sort of constructive uptrend or a base pattern. What you're doing is you're coming out of this streaking move to the upside following that first viable gap up. So this actually looks more like an exhaustion gap and has to be considered on that basis. So you would probably, being able to buy this one, you would want to buy that one, but you know, being in a position to buy this one, I think you would not want to be doing that. Biogen did continue to build a base, and it did continue higher later on, but this was pretty much the top at the time. Here's Finisar starting a move in 2010. It wasn't a huge move or a long move. It lasted for a couple of months, but it was a profitable move, and it started with a viable gap up. And again, you can pretty much eyeball what it is you're looking at and looking for. Herbalife, now here's a case where you have one viable gap up, and then you have a very nice, well-formed uptrend. It doesn't have that sort of parabolic move like that Biogen gap up, that second gap up we saw on the chart in Biogen. It's coming out a reasonably well-contained, well-formed uptrend. Boom, that one works as well. It's not so parabolic. And so as you move higher, though, you have a third one, and now this begins to become a little bit too obvious. And so on this basis, you would probably be more cautious about this relative to these other two, given the fact that by the third one, the rule of three is in effect here, and the third one everybody expects to work, and it doesn't, and it fools the crowd. Here's Baidu's move again in 2011. Started with a Buyable gap up. Here's Apple, and then interestingly, Apple right now is trading below. Right now, I'm seeing it in real time because we are live here, real time during market hours. I'm seeing the stock trading at 442.12 on the bid and dropping, and that's below now of this Buyable gap up that occurred in January of last year. So a year later, Apple has round tripped from 705 on the peak all the way back down here, and looks like it's headed lower. But in any case, that move, and it was a playable move and a very nice move in Apple last year at this time roughly, started with a Buyable gap up. Now, today, over the last couple of days, we have a shortable gap down in Apple, but we'll save that topic for our next book, which is going to be a treatise on short selling. Priceline started a big move in 2012 as well with a Buyable gap up. You can see it again. This blue line that's running along the tops of all the little volume bars, that is a 50-day moving average of volume. And so you having that on your chart, you can easily see that this is a lot more than 1.5 times average daily volume. So that's easy to eyeball. Here's Tractor Supply in 2012, had a Buyable gap up. Tractor Supply, a little bit of a volatile stock, and so tiny bit of porosity here along the lows, but then continued higher and had a nice move from there. Here's 3D Systems, started its most recent move with a Buyable gap up. Here's a breakout from it's kind of a sloppy breakout, but it does work. And the stock continues higher in choppy fashion. And you have this Buyable gap up coming out of this uptrend, and that never really goes below the intraday low of the gap up day, and the stock has continued higher from there, and currently it's trading at around $70, $71 and holding up. But now this second gap up in the pattern, we probably wouldn't want to buy that because it happened so soon after this one. And so you must recognize that if you do buy it, you can use the intraday low around 68 or so, just underneath 68, probably 67 and a lot of change there. But you could theoretically buy it here using the low of this day as your stop for that portion of the position that you bought here. So let's say you bought 50% of your position here, and then you want to come in and say add 25% to your position here. Well, that 25% you probably want to use a stop here, because once you get into the second one, and notice this is starting to get a little bit parabolic, that could be risky. We'll see how this pans out over the next several days and weeks because it is a current example. But it does show how, as you do progress up, you must keep in mind this sort of parabolic movement going on and realize that as it gets more parabolic, gap ups that occur further up will carry more risk. So you want to keep your stops, you want to adhere to your stops and not allow yourself to get top heavy if it does fall back below the intraday low. Krispy Kreme donuts, this actually right here is a Buyable gap up, and then another Buyable gap up because it's not occurring too late from the breakout, and the amount of volume shows a lot of power. And Krispy Kreme today is trading at about, let's see, $12.85, so it's hanging in right about here right now. Now that's this second one you probably won't want to buy again because now you're 1, 2, 3. But it's showing a lot of power. Stock maybe needs to go sideways for a bit here. Poly 1, this is another current one occurring just a few weeks ago in January, I think it was, the start of the year. And you had a gap up here. That's a Buyable gap up. 21, basically, a little bit above is your stop. And the stock's holding up here above 22. And currently today is at 22.59. It's up 7 cents as I speak. But this also, you might notice, if you look at a weekly, is a 3 weeks tight or 4 weeks tight kind of pattern, and that looks good on the heels of this Buyable gap up. Commvault Systems, it also started with a Buyable gap up coming out of this little flag or short base formation. I think this is about 6 weeks, 5, 6 weeks. See the huge volume, it comes out and streaks higher and continues to go higher from there. And today that stock is up at $74. Failure analysis. Dr. K, I was going to let you look at some of these stocks that fail and the reasons why they failed and what clues might have been inherent in the charts at the time.
All
So
right,
looking at the first one, Green Mountain Coffee Roasters.
okay, so we've got the gap up, and you can see that it undercuts the low of that gap up. Now that first day, you don't want to sell it that first day because that's it's not beyond that acceptable level of porosity of 1 to 2%. But on, it looks to me like the 4th, 5th, 6th day, and then it comes right down through, not only through the 10-day moving average, but it clearly violates the low of that gap up low, and so you want to be selling it, you know, at a maximum, based on the volatility of this chart pattern, a maximum of 2% under that low. Now, there's a rule that I use. If the stock has traded, in this case, it's the 6th day, 1, 2, 3, 4, 5, 6, 6th day, round trips and comes right back down, you want to sell it at really minimal porosity. You know, sometimes you just cut and run as it comes below the low of that 2nd day. Therefore, you're only giving up what looks to be probably a fraction of a percent.
Yeah, also notice another thing we were talking about is how many gaps are in the pattern. You actually see 1, 2, 3. This is the 4th one. Notice this one here probably would have stopped you out, but it depends on how much porosity you allowed for. But it does stop out pretty quickly. But usually by the time you got 3 or 4 in the pattern, you are getting a little bit long in the tooth. And keep in mind Dr. K's rule where on the 6th day, if it's round tripped by the, is that the 6th day or later or within 6 days, Dr. K?
6th day or later. In other words, it should have gone. You know, it should have. You've given it enough time, and it's not working out. So, in other words, you're not going to be very forgiving when it comes right back down to that, the low of that, the gap up day.
Right. And I should note that that is a refinement to the Buyable gap up that we discussed for the first time in our first book, Trade Like an O'Neill Disciple. Citrix Systems. What do you think was the problem here?
Well, it's a sloppy stock. You can see prior to the gap up that it tends to violate the 50-day, and that always makes me a little suspect. I would point out, though, that a Buyable gap up can often reset the pattern so that even if it was sloppy beforehand, sometimes it's off to the races from that point it gaps up. In this case, you're going to sell it on the 3rd day because it undercuts the low by, it looks like more than 2%.
Okay. And we want to show you these because we don't want you to get the idea that these work all the time or it's some magic money method of just printing currency in the markets. It does fail, and when it does, you just follow the rules. But the key here is that, number one, a lot of amazing price moves can occur after a Buyable gap up, and so you do want to put yourself in a position. And the second thing that we think is very nice about these, nice and neat, you might say, is the fact that you do have a very low risk proposition in that you are using the intraday low of the Buyable gap up as a quick stop. And the closer you can buy to that intraday low, once you're able to determine it, that's a lot of times easier said than done, we should remind you. But once you're able to determine that intraday low, the closer you can buy to that low, the lower your risk is. And sometimes it might be quite a bit lower than, say, the 7 to 8% standard stop that the O'Neill methodology would use for a standard breakout. So you're no worse off than using that sort of stop loss. In fact, in many cases, you're better off. Intuitive Surgical, what do you think here, Dr. K?
Well, you know, right here, oh yeah, it's a little slow on my screen. You know, it's looking good. You know, it's a bona fide Buyable gap up, but it clearly violates it. So, you know, 1, 2, 3, 4, 5, 6. You're selling on the 6th day.
Yeah, and of course it's going to do one little blip to the upside just to tick you off, but that's just part of the game, and you have to stick to your stops because after that, this thing plummets to the downside very quickly. Cephate. Oh, wait a minute. That's wrong one there. Nation Star Mortgage Holdings. This is a current one, and this actually looked pretty good coming out in early January. I think this is January 7th, about 2 weeks ago. And since then, it took it 1, 2, 3, 4, 5, 6 days. It's not really going anywhere, and it broke down. And now it's pulling back to fill the gap. I don't know if this thing is going to come back in and stop somewhere in here and just pull back. But the fact that it's failed here, you're already stopped out. And if you want to try and buy it back, say coming into the gap here, that would depend on a number of factors, namely how constructive the pullback is. And we're already seeing, I believe, today, I think, correct me if I'm wrong here, Dr. K, but is volume picking up on this stock today?
It looks to me, 1 second here. Yeah, it's just slightly.
Yeah,
Right.
so it's good, but yesterday was higher.
Trying to
This
get
is
support
updated.
because right now it's trading mid-bar, but the problem with this one also is that it's contextual to other members in its group. Other housing stocks are actually have been outperforming, and so this one's clearly lagging as it goes lower and lower. So you
Right.
don't want to be in a laggard.
Right, but again, an example of one that had a lot of promise and it flakes out very quickly, and using the new rule of 6 days without any price progress, you could have been selling pretty early. We were out of this thing pretty quickly, but trying to test some back, buying back on this pullback here looked okay yesterday, but today, yesterday with volume picking up by the end of the day, that was not really a place to be buying the stock, and this might even fail. So we're not going to come back to this until we see a new buy point on the stock with downside volume picking up. So in summary, the reason we love Buyable Gapups is that they're often too high to buy. Well, that's how everybody sees them, and so this increases the contrarian odds of success since the crowd is basically scared away. They're not going to touch it, just like the crowd thinking that you got to keep buying Apple on the way down. As long as everybody keeps thinking that, I'll probably keep shorting it. But in any case, the crowd is usually wrong, and Buyable Gapups work because the crowd is scared to death of buying them. Now, Buyable Gapups often lead to sharp, sustained upside price moves, particularly, and I think this is key, in the earlier stages of a stock's overall price move during a bull market. So if you see a stock breaking out at the beginning of a bull phase and you've had a follow-through within the last couple of weeks, and here you see a stock gapping up for the first time out of a nice base, that is going to have a higher probability of a bigger price move. As they occur further up, sometimes that can mute the price move, but the most optimal time to come in is in the earlier stage of a stock's overall price move during a bull market. Coming out of initial or second stage base consolidation is what you would prefer to see at or near the start of a new bull market phase. And Buyable Gapups that occur in strong, fundamentally strong and thematic leadership have the highest probability of success. So just wanted to remind you we have our new book out, In the Trading Cockpit with the O'Neill Disciples. And yes, we have corrected that error on the graphic here. And our first book, Trade Like an O'Neill Disciple. People ask, why are you called the O'Neill Disciples? Are you guys full of yourselves? And is this your ego talking? Actually, this is a little bit of an inside joke, and it comes from a book that was published in early 2000 by TradingMarkets.com. It was titled The Best Conversations with Top Traders. And I would remind everybody that that book was printed in early 2000. I got to tell you, in the 1999 market, it was amazing how many incredibly brilliant people were suddenly investing in the market. You know, that was uncanny, right, Dr. K? I mean, in lesser environments, I don't know where all these smart people went, but it's amazing how many brilliant people there were in 1999. And as they say, many geniuses are born of a bull market. And to some extent, that has helped us in the 90s with our performance, and a lot of the tools that we've come up with in the 2000s are to essentially devised to address the difficulties of the market in the 2000s, because you are in this sort of big sideways, choppy consolidation over the last decade, similar to the 1970s, following the 1990s. And Dr. K and I both started in the early 90s, which was a beautiful time to start because we participated fully in what was essentially an upward parabolic market that ended in March of 2000, and that went on for about the whole decade. So keep in mind, whenever you see anybody who is considered a guru and you're in a market where everybody seems smart, remember it's the market that makes people smart, not the investor or the trader themselves. All you can do is put yourself in a position to get lucky, and a lot of these techniques that we use now, that's exactly what we're trying to do, and the Buyable Gapup is one of the best tools for putting yourself in the position of getting very lucky. So now I think we'll take some questions, and let's see if I can get some charts up. Somebody's asking, Dr. K.
I was going to mention, keep in mind that everything's relative, everything's always taken in context, and so if you have a year where the average, the market's up, 40%, Nasdaq's up 40%, and a lot of people are up 50%, then as an individual investor, you would hope to be up at least the average. So in other words, if you're up 50%, I wouldn't call that a banner year. I'd call that pretty average. But if you're up over 100%, then you're doing all right. So always keep that in mind.
Yeah, oh, and I didn't finish my thought on that. The book, Dr. K and I were interviewed in the first chapter, and the title of the first chapter was The Disciples, which we thought was a funny name at the time, and so we have used it in our current title sort of as an inside joke, calling ourselves the O'Neill Disciples. So more joke than anything else. Somebody's asking, is Intuitive Surgical, which you can see here on this daily chart, and let's see if I can make this a little bigger. Is this a Buyable Gapup, Dr. K?
The pattern's too sloppy, so it doesn't make you want to buy something that's out of a constructive basing pattern. In this one, you'll see first of all in December 19th and 20th, it had huge volume down moves, and then prior to that, it had gap downs in July. And you'll see, it's just trading water around the 200-day moving average. It's finally breaking out above that, but its past history doesn't make me feel comfortable about buying this one.
Okay.
Now it could set up. It could get real tight in here. It could get constructive, and then issue a pocket pivot, and then I'll revisit it. But until it does that, I'm not interested.
Okay. Now is this a Buyable Gapup in this Chewy's holdings?
Yeah. It's a pocket pivot, base breakout, and Buyable Gapup all rolled into one. And
using...
in the report, it's a really thin stock. So you got to position size carefully. However, the Russell 2000, which is a small cap index, has been outperforming for the last few months. The other thing I like about this stock is that the volume is just massive. I did one of my studies was to look at stocks that have volume, that trade volume at least over 1,000% that day, and that's often a turning point for the stock. It doesn't matter what the cap size is. What I've noticed is for small caps, it often leads to institutions piling in. So what we'll see after a day like today, if this stock works, we'll see a lot of tall blue bars ensue, and the volume average will go from about 80,000 or 100. It's what 188,000 right now. It'll certainly climb, and the stock will potentially. You want to see a stock like this double because it is a small cap name. You want to get a lot of bang for your buck, a lot of time value for a name like this, and it's going to be volatile. So keep that in mind.
Someone asked, is session 1 recorded and available? I believe it is. We'll be sending out an email on that. RMD, ResMed has a Buyable Gapup. What's your take on this, Dr. K?
RMD. Well, it's not extended. It had good earnings report today, so that's sending it higher. The earnings are slowing a little bit. The sales are accelerating, but the sales are still low teens. The institutional sponsorship has been climbing for the last 3 quarters. I mean, overall, the industry group is 125. It's not a bad stock. It had a prior gap up in August, but then it had a pretty down, a fair down day in October, and these are on the basis of earnings reports. So I'm not jumping all over this one, but it's interesting, and there's certainly worse stocks out there. Right. But we want to be focused on the best, absolute best, and I don't get that feeling with this one that it's an absolute best.
Somebody asked what trading platforms we use. We use eSignal for our quotes, and we use Wanda, William Neal Direct Access. That's an institutional product, and for our charts, and our trading platform is Night, so that's an institutional platform not available to the retail public. Let's see. Someone asked, so does characteristic number 5 imply that the initial stop should be set at the intraday low of the gap up day? Yes. Does Netflix meet the Buyable Gapup? Here you go, Dr. K. Well, it's moving higher after yesterday's Buyable Gapup. And I guess it was. So, but it's a difficult one to deal with, mainly because you're operating with a pattern that is, if I can move to a weekly chart here, that's what you're looking at. So, that's tough to consider because you're just coming off the extreme lows after a massive breakdown in the stock. So you're not, that's a tough one. And if you bought it on that basis, it also shows that you can just use the rule as it is and buy pretty much anything that's a Buyable gap up, because if you get pushed below the intraday low, that's where you're stopped out.
Yeah, you want to avoid bottom fishing in general. I mean, unless you're coming out of a egregiously bad market like the 2008 crash, and there were some names that were bottom fishing names in the spring of 2009 that were buyable, but then that's because everything had gotten knocked down. Virtually there was nothing left standing. But in context of the current environment, there's a lot better names to play. You don't want to be getting involved in stuff like this because it's going to be pretty volatile even if it does work. And again, you want your time value to work for you, so you don't want to be taking 4 steps forward and 3 steps back, and that's also liable to shake you out of your position.
Where does porosity come in?
Well, any buyable gap up, if it's a buyable gap up, then you want to use the low of the gap up day, but allow for typically 1 to 2% undercut of that low.
Yeah, would you say for
the
more
stock is really volatile, or in that other case, like with Baidu, where it just went straight up off the bottom and then gapped up, you might want to give it a little bit more than 2%. So it's always in context of the pattern.
Right. Somebody asked, do you drop down to a smaller time scale on your charts to more closely track the upward resumption? No, we just watch the daily chart, so don't really look at any intraday charts or anything on this. What about massive gap ups, like 15 to 20%? Is that too big of a gap, Dr. K?
It's context with the chart. If the stock had a lot of power before the viable gap up, then it's a 15% gap up might be quite small in relation to the chart. I mean, there's stocks sometimes that'll go up 40%, and then they'll keep going from there. Biotechs have a tendency to gap up a lot more, and so keep that in mind. Keep it in context of the sector you're dealing with. So if it's a biotech sector, then and given the news, you might want to still buy something that is up 40% on the day. If it's something like if it's something not that doesn't do that normally, then you might think that, okay, I'm not going to take a position at the open. Let's see how it trades the rest of the day, and then maybe I'll take a small position for a stock that's going up that much. Especially if it's like a retail stock, it's unlikely that it will do that. And also, if it gaps up so much, it might be a bit excessive, and it might be more subject to retracing from that gap up point.
Okay, we're going to take a few more questions. We're kind of running out of time here, but someone asked, do you like adding to the position on a pullback to the gap up point weeks later?
Yeah, that can work, but keep it in context again with the industry group the stock is in. In other words, if that stock is outperforming its peers in its industry group and it's acting stronger than the general market, and let's say the market's just been weak, pulling that stock all the way back to its original buy point, original gap up point, then you can take a second position, clearly knowing that your risk is minuscule by that point, because you're not going to give that gap up low any porosity because it's round tripped itself. So you could theoretically be buying right next to your sell point. In other words, you could set your risk literally at like 1 or 2% on your buy point, and so you could take a reasonably large position there as your second buy point, and then if it doesn't work out, you've lost 1 to 2% on that portion.
After a buyable gap up, do you use a 10-day moving average for a stop? You actually use the intraday low of the gap up day as your stop, and whether or not you use the 10-day moving average depends on the 7-week rule, and that's actually going to be what next week's session 3 of the Disciple Boot Camp is going to be covering. Is there a distinction between a buyable gap up due to an earnings report versus not? No, there is no distinction. A lot of times a buyable gap up is caused by an earnings report. Does it need to come off the 50-day moving average with a higher percent volume or just higher volume than the day before? No, it needs to occur on volume that is 150% of average daily volume. And so that is 150% of, so 100% of something is the full amount. So if the 50-day moving average is 1 million shares, 100% would be 1 million shares, 150% would be 1.5 million shares. And I think we've answered most of the other questions, and we have to end the webinar at this point because we've overshot our time. But it is being recorded and will be posted for viewing on our website. We will email out the YouTube site where the video is going to be up to all of you. And we thank you for attending today and hope to see you next week when we cover the 7-week rule, which is essentially a very neat system for handling positions once you've bought them and determining concrete sell points, because we know a lot of people have trouble. They don't really have trouble finding stocks to buy that go up and making money. They just have trouble figuring out when to take their profits. And that's what we'll be covering next week. So we'd like to thank all of you for attending, and we'll catch you next week. Take care and happy trading.
So long, everyone.